Hey everyone, welcome back for another deep dive with us.
Yeah, thanks for joining us.
So today we're going to be focusing on, I think something really important for investors to understand, and that's yield spread.
Absolutely.
And to help us with this deep dive, we're tapping into the expertise of Michael Linton
Yes.
from Chicago Deal Flow.
You got it.
And you can find his insights over at chicagodealflow.com.
Wonderful resource.
Yeah, it's a great website. He's got a ton of great articles and resources over there.
A
And
lot of great information.
Michael's been navigating the Chicago commercial real estate market for almost 40 years.
Yeah.
So,
He knows a thing or two about spotting good deals.
yeah, he knows what he's talking about.
He does.
So understanding yield spread, it's like
It's really important.
having a secret weapon
It is.
in your investor toolkit,
Absolutely.
especially in a dynamic market like Chicago.
That's right.
So let's get right to it. What is yield spread and why should we care?
So yield spread is sometimes called cap rate spread. It's the difference between the capitalization rate, or cap rate,
Right.
of a property and the current yield on the 10-year U.S. Treasury bond.
So cap rate, that's a measure of a property's potential return.
Exactly.
But why are we bringing treasury bonds into this?
Well, that's because the 10-year Treasury bond is kind of considered like the benchmark
Okay.
for like a risk-free rate of return.
Okay.
It's backed by the U.S. government, so it's
Yeah.
seen as a super safe investment.
Gotcha. So we're comparing the potential return from a riskier investment like real estate
Yeah,
to a super safe investment like a treasury bond.
exactly.
yeah.
And yield spread helps us kind of quantify that difference
Okay.
and gives us a sense of how much extra return or like
Extra credit.
extra credit
Okay.
that we're getting for taking on that additional risk.
I like that extra credit.
You got it.
So how does this extra credit actually play out in real world investing?
So imagine you're considering a couple investment options, right?
Okay.
One is that super safe Treasury bond.
Yeah.
Maybe it's offering like a 4% yield.
Okay.
The other is a multifamily property
Okay.
in a bustling Chicago suburb
Right.
with a cap rate of 7%.
Okay. So right off the bat, the property seems like it's got the potential
It does
for a much higher return
much higher,
than the treasury bond.
exactly, but higher potential return
Right.
often comes with higher risk.
Of course.
And that's where yield spread comes in.
Okay.
So in this case, the yield spread would be 3%.
Okay.
The difference between the property's 7% cap rate
All right.
and the Treasury bond's 4% yield.
Yeah, sure.
So that 3% is the extra credit
Okay.
you're getting for venturing into the real estate market.
So the bigger that yield spread,
Yeah.
the more extra credit we're getting for taking on the risk.
Yeah, you got it. And that's a key insight that Michael emphasizes.
Okay.
A wider yield spread often suggests that the real estate market is, perceived as more favorable,
Okay.
meaning investors are willing to accept a lower, risk premium because they're confident in the potential for strong returns.
So if I'm seeing a lot of properties with wide yield spreads,
Yeah.
that could be a good sign.
Could be a positive indicator.
Right.
But remember, context is everything.
Right.
Yield spread is not a crystal ball.
Yeah.
It's one piece of the puzzle.
Uh-huh.
It needs to be considered alongside other market factors,
Okay.
like interest rates, economic conditions, and local trends.
So it's not as simple as just saying widespread equals good deal.
Nope.
You got to look at the bigger picture.
Absolutely. And that's something that Michael stresses.
Okay.
He encourages investors to understand, why the yield spread is what it is.
Okay.
What's driving investor sentiment?
Right.
Are there any underlying risks that might not be immediately apparent?
Yeah, that's great advice.
Yeah.
So we've talked about wide yield spreads.
Yeah.
What about when that spread starts to narrow?
Okay.
What's the signal there?
Well, a narrowing spread could indicate a few things.
Okay.
It might suggest that the market is becoming less attractive to investors, perhaps due to economic uncertainty or rising interest rates.
So if that extra credit starts to shrink,
Uh-huh.
it might be a sign to proceed with caution.
Yeah, exactly. It doesn't necessarily mean you should avoid investing altogether,
Right.
but it does warrant a closer look.
Okay.
Why is the spread narrowing? Are there specific risks associated with this particular property or market?
Yeah.
Is there something better out there?
This is fascinating.
Yeah,
Yield spread is more than just a number.
it is.
It's a reflection of investor confidence and market dynamics.
That's right.
But I'm curious, how does this play out in specific areas?
Yeah.
Especially here in the Chicago suburbs.
That's a great question. And Michael provides some really insightful observations about different suburbs and how their unique characteristics
Yeah.
can influence yield spreads.
Interesting.
So let's delve into those nuances next.
Okay, let's do it.
All right. All right. So let's zoom in on some specific Chicago suburbs that Michael highlights in his work at Chicago Deal Flow. And remember, these are insightful observations, but always do your due diligence and research.
Yeah, of course, always.
Before making any investment decisions.
Absolutely. Sounds like a plan. I'm ready to put on my yield spread detective hat.
All right, let's do it.
And explore these suburbs. So where should we start?
Well, Michael talks about how each suburb has its own unique flavor when it comes to real estate.
Okay.
Some, like Libertyville, are known for their stability.
Right.
Others, like Lake Zurich and Crystal Lake, are experiencing more rapid growth.
Okay, so different dynamics at play.
Right.
How does that affect yield spread in those areas?
So let's take Libertyville as an example.
Okay.
Michael describes it as having a pretty stable commercial market.
Okay.
This often translates to moderate cap rates.
Okay.
Meaning the potential returns might not be as high as in like a booming area.
So why would investors even bother with Libertyville if the returns aren't as impressive?
That's where understanding like investor psychology comes in for some investors. Especially those with a lower risk tolerance. Stability is more valuable than a sky-high potential return.
So it's not just about chasing the biggest numbers.
Right.
It's about finding investments that align with your individual goals and comfort level.
Exactly. In Libertyville, you might see narrower yield spreads.
Okay.
But that doesn't mean it's a bad investment.
Right.
It just means investors in that market are prioritizing stability and consistent returns over taking on a lot of risk.
That makes sense. It's like choosing a reliable, steady Eddie stock over a volatile, high-growth tech startup.
Exactly.
Both have their place, depending on your investment strategy.
Precisely. Now let's shift gears and head over to Lake Zurich and Crystal Lake.
Okay.
Michael points out that these are areas with more dynamic commercial real estate markets.
Okay.
They're growing, attracting new businesses and residents, which can create more opportunities for appreciation.
Okay, so more growth potential. Which could mean higher cap rates and wider yield spreads.
Though that's the general idea, but it's not always a guarantee.
Right, of course.
Remember, growth also comes with its own set of risks.
Sure.
A new business might not succeed.
Right.
Or development plans could stall.
So it's like a higher stakes game.
Yeah.
The potential rewards are bigger.
Yeah.
But so are the potential downsides.
Right. In Lake Zurich and Crystal Lake, you might find properties with wider yield spreads, reflecting that higher risk and the expectation of stronger returns.
Okay.
But it's crucial to dig deeper and understand the specific drivers of that growth.
Right.
Is it sustainable? Are there any red flags?
This is making me think twice about just chasing the widest yield spread. It's more nuanced than that.
Absolutely. Michael stresses the importance of looking beyond the surface numbers.
Right.
He encourages investors to analyze the underlying fundamentals of the market and the specific property.
All right, so what are we looking for there?
Well, what's the vacancy rate?
Okay.
What are the lease terms?
Okay.
Are there any upcoming developments
Yeah.
that could impact the property's value?
So it's like being a detective.
It is.
Piecing together clues to determine if that yield spread is justified.
Exactly. And that's where Michael's expertise really shines.
Okay.
He understands the intricacies
Yeah.
of the Chicago market.
Right.
And can guide investors through those complexities.
This is all incredibly valuable information.
Yeah.
But what about those established commercial hubs?
Yeah.
Like Schaumburg and Hoffman estates?
Okay.
How do they fit into the yield spread picture? All right, so we've got these stable markets like Libertyville, where investors are drawn to consistent returns.
Right.
And then we have these high-growth areas like Lake Zurich and Crystal Lake, where the potential rewards might be bigger.
Yep.
But so are the risks.
Yeah.
Where do places like Schaumburg and Hoffman estates land on that spectrum?
Schaumburg and Hoffman estates are fascinating because they're these established commercial hubs with a diverse mix of property types. You've got everything from office buildings to retail centers, industrial properties, even multifamily residential.
So it's like a real estate buffet with something for every investor's appetite.
That's a great analogy. And that diversity makes them really interesting.
Right.
From a yield spread perspective, you can compare yield spreads across different property classes.
Okay.
And see how they stack up against each other.
So, for example, I could compare the yield spread on an office building in Schaumburg to a retail center in Hoffman Estates.
Yep.
And get a sense of which property type might offer a better risk-reward balance.
Yeah, exactly.
At that moment.
It's like having a side-by-side comparison to see where the market is placing its bets.
I like that. Okay.
And remember, Michael emphasizes that yield spread is just one data point.
Right.
It's essential to consider other factors like vacancy rates, lease terms, and the overall health of the local economy.
Yeah, this is all starting to click.
Good.
But let's step back for a moment. We've covered a lot of ground today.
We have.
For our listeners who are just starting to wrap their heads around yield spread, what's the one key takeaway?
I'd say the most important thing is to remember that yield spread helps you assess risk and potential return in real estate.
Okay.
It's not a magic formula, but it's a valuable tool that can guide your investment decisions.
And a tool that can help us unlock opportunities
Absolutely.
that we might otherwise miss. Right?
Yeah.
It's like having that secret decoder ring.
It is.
We talked about earlier.
Exactly.
By understanding yield spread, you can start to decipher the language of the market.
Yeah.
And make more informed choices. And remember, you don't have to go it alone. Michael and his team at Chicago Deal Flow.
That's right.
Are a wealth of knowledge and resources.
Definitely recommend checking it out.
So listeners, if you're ready to level up your real estate game, head over to chicagodealflow.com.
Definitely.
You'll find tons of valuable insights from Michael and his team, including in-depth analyses of the Chicago market and specific suburbs.
Great resource.
Well, this has been an incredible deep dive.
It has.
I feel like I've gained a whole new understanding of how to navigate the real estate market.
Good.
Especially here in the Chicago suburbs.
Awesome.
So listeners, next time you're evaluating a property, don't just look at the price tag or the cap rate.
Right.
Calculate that yield spread and see what story it's telling you.
Yeah.
And remember, a big thank you to Michael Linton and the Chicago Deal Flow team for their incredible insights.
Yes, thank you.
Until next time, keep exploring, keep learning, and keep investing wisely.